Good afternoon, everybody, and thank you for joining this webinar on the topic of Insurance, is it ripe for disruption? The digital revolution, the increasing use of telematics, the rise of comparison websites, unprecedented events such as the pandemic, flooding, and coastal erosion have led to the question, is the 2021 insurance model fit for purpose? Before we have this discussion, first I want to say a few words about IORMA, who have organised this webinar. So the IORMA Consumer Commerce Centre is a neutral resource for businesses and governments that recognises their need to understand and respond to the ways in which the 7.8 billion global consumers are changing, in the products and services they want and need, and the ways they want to obtain them. These changes are happening globally, driven by developments in society, in business and in technology. And IORMA are producing a series of thought leadership discussions, which are held every other Thursday, and topics are chosen from IORMA's horizon scanning, its surveys, and its research. So first of all, I'd like to move on to introduce myself and our excellent panelists. My name is Dr. Julie Wall, and I'm a reader in computer science at the University of East London. I work on research in deep learning, natural language processing, and natural language understanding. And I'm really interested in today's topic, as I'm currently involved in a research project where we're trying to detect fraud and claims calls in the insurance industry. But let's introduce the experts. So our first panelist is Paul Mcdonald, Executive Director of Global Digital Foundation. Paul, would you like to say a few words about yourself?
Yes, I'm Executive Director of Global Digital Foundation. I'm former Head of Office of the Information Technology and Innovation Foundation in Brussels. And my paper concerning the application of GDPR and equality legislation to the insurance markets was published in Economic Affairs in 2015. So this is a subject that greatly interests me.
Excellent, thank you, Paul. Christopher Hoff from Key, would you like to introduce yourself?
Of course. Hello, everybody. My name is Christopher Hoff. I'm a Senior Portfolio Manager at Key. My background is actuarial, so I've worked in the specialty insurance market for the last 10 plus years in various pricing, capital modelling and reserving roles. Key is the first algorithmically driven digital syndicate at the Lloyd's of London market. And what we're trying to do is disrupt a very traditional and very old market with some new technology.
Excellent, thank you. Our next panelist is Seth Williams from the Association of British Insurers. Seth, would you like to take the opportunity to say hello?
Hi there, thanks Julie. Yeah, I'm Seth. I'm Head of External Affairs for the ABI, which is the Insurance and Long-Term Savings Trade Body, and it's my job to look after the political and communications engagement for our body, for the industry. And what's my interest today? Well, insurance, in my view, is always ripe for disruption, and insurers thrive on it.
Great. And last but not least, our final panelist is Peter Evans from Deloitte. Can you say something?
Yes, hello everyone. Thank you for having me today. I lead up insurance research for Deloitte in the UK. So I look at emerging trends and really big strategic topics for Deloitte's insurance clients, and I attempt to bring them insights, in other words, data or opinions that really help them with strategic decision making that they might not have otherwise had. My principal interest in the topic of today's session is, if you like, in separating the noise from the reality. So is the market ripe for disruption? And if it is, why haven't we seen it before? And what might we see in future?
Excellent. Okay, so I think we've got very relevant panelists. So let's kick off with our questions. Please note, for the participants, you can write your questions in the Q&A button at the bottom of the screen throughout the webinar. And then at the end, we will go through all of your questions. So first of all, Chris, I have a first question for you. So Chris, you have asserted that the insurance sector is lagging behind other markets when it comes to innovation and disruption. And your company has set about creating the first algorithmically driven digital-only Lloyd's syndicate in order to revolutionize the Lloyd's insurance sector market. So Key's advertising, you claim that its focus is on creating a data-driven, broker-friendly experience, enabling it to be able to transfer risk quickly and efficiently. My question is this one of the ways forward for the industry? Is this what every other sector should be looking at?
Yeah, I mean, I think the Lloyd's of London market is quite a unique market in whereby we have this concept of a leader and a follower. So leaders kind of do the majority of the work, and the followers back up behind some of that work. So I think what we've been able to capitalize on is, with some of the advances in computational power and cloud computing and data science techniques, we've been able to replicate a lot of what a follow vehicle does by using an algorithm or by using software to automate a lot of those practices. I think that there's still way to go. So if you look at kind of the accuracy of NLP techniques or OCR techniques currently, the accuracy rate that we're seeing at least is still not quite 100% kind of bulletproof. So there's some parts of the specialty insurance market which can't be replicated yet, but I certainly think that's the way that the trend is going. And we've seen a huge amount of positive reaction from the market with what we're doing. I think brokers are really signing up to it work positively too. I think they're seeing it as a way that they can reduce their operating expenses. I think, obviously that 2020 has been a strange year, and there's been a lot of difficulties, but it also has had some positive impacts as well. I think it's pushed our market in particular to utilize digital risk transfer a lot more. So there's an initiative within the Lloyd's market to use digital placing and digital binding, which was slowly picking up, and I think the usage rates were climbing, but 2020 has certainly seen that accelerate, and hopefully we can leverage off the back of that as well.
Yeah, it definitely seems that they're really following what's going on in the digital age today. I wanted to follow up on what you were saying about automating practices. That's something that I would be really interested in, using digital innovation for automation. How are you actually applying that? Is it applying it, the consequences of that can be ethically for your customers? Is that something that you are considering?
So I think our approach essentially is so around kind of 40% of a Lloyd's insurance vehicle is underwriting personnel.
Okay.
So by utilizing an algorithm to replicate that, so the risk selection that an underwriter makes, we're able to significantly reduce our expense ratio. We also believe that by using an algorithm, you can take in a huge amount of data points that a human would struggle to take into account in any one go, including what's happening in your kind of active portfolio and potential portfolios, where there are other kind of external data sources. We can use all those data sources together to make a decision real time with an algorithm. I think what that also opens up is, once you kind of digitize that first data point that comes into your company, you can pass that data point throughout the rest of the company. I think one thing that companies sometimes struggle with is that first data point can often be a PDF or an Excel document that was changed in format through different carriers, to different brokers. So if you can kind of make that data point consistent and then pass it through the rest of your company, you can then automate some of the checks and the operational impact that you'd have on a traditional syndicate. Excellent.
Okay, thank you. What about our other speakers? What are your thoughts on this digitization of insurance and bringing it into the AI age, really? Let me see.
Sorry, just make a couple of observations. I mean, I think from my understanding, I mean, I should have said I was formerly the representative of the Insurance Ireland, which is like the Irish ABI in Brussels, and the regulator in Dublin. And it seems to me that a lot of insurance companies do try to cope with legacy systems in their back end in terms of product development and in terms of account management. And so there is a problem there and a challenge there for insurance companies, and new companies that are startups, perhaps with whole new technology front and back end, may have some advantages in terms of developing products more quickly to existing insurers, because there's an ongoing challenge for insurance companies.
Yeah, it's a good point actually about the amount of legacy systems that you would have.
Yeah, I would agree in that one of the big challenges that prevents insurers, and let's focus on the Lloyd's market, in improving the accuracy of the underwriting, is that the data that they'd like to use is often locked up in silos, or it's held by the broker, or it's updated infrequently. But what we're increasingly seeing is clever startups come to market that help to solve some of those problems by using external data to underwrite at a more granular level, and therefore to be far more profitable. And there's some really interesting use cases where that works very well. And it's a case of bringing in the right external data. Let's take commercial property, for example. There's lots of external data that isn't used to inform the underwriting decision about underwriting that building that could be. And I think it's a case of bringing it on stream in a way that is manageable for the underwriter. And we're starting to see that.
Do you think that expertise is in the insurance industry? Are they bringing it into the industry, or is it just being brought in on a contract basis? That, you know, being a software developer, machine learner, is that naturally in the insurance industry, or are they looking to just bring people in as and when they need? How does it work?
I can speak from a key perspective, if you like. So I guess for us, we took a partnership approach, really. So we've joined up with Google, with University College London, and with Brit to help us on the journey and provide some of that, you know, whether it's data or SME knowledge and experience to help us build out our platform. And then over the course of time, we're kind of hiring those members into our teams. We're typically looking outside of the traditional market that we would look in to bring in skill sets from outside of the market. Because I think you know, my opinion is that the market's not kind of has a big flux of that kind of skill set. I think we're slowly starting to see that drip into the market.
Can I ask a question?
Yeah.
Yeah, and this is a question for the sort of insurance professionals, because it's just a question I have, and I think it's an interesting question, which is, if you were to sort of say that, you know, the book selling industry at the moment has been totally transformed by Amazon, and so, you know, whatever percent Amazon has of the book selling market, it's got to be, I don't know, if it's 50%, I wouldn't be surprised, or more. So we can say that that industry has been thoroughly disrupted by a whole new technological paradigm for stock management and for distribution and customer management and so on. If you were to sort of put Amazon on a kind of a, you know, if you were to say that the book distribution industry has been totally disrupted and it's sort of 7 out of 10 in terms of total disruption, I mean, where's the insurance industry on that score? It seems to me it's still very, very early days in terms of disruption, and that startups that are coming in with new technology front and back end, it's still a tiny part of the market, isn't it?
Who wants to take that one, Seth?
Yeah, I mean, I was going to come on several points, really. I mean, I think I'd start by sort of answering your question, Paul, which is that, I mean, sort of agree and sort of not agree. I mean, notoriously difficult to start an insurance company, given the capital you need to do. But I think there is a clear pattern of established insurers investing in startups. And to the point about bringing the skills in, that is definitely happening. You know, whether it's Direct Line and Brolly, for example, bringing in technology which will ultimately designed to help the customer journey. So it might seem like, in some senses, the industry lags behind. And I think that is definitely true to an extent. I would say, though, that, for example, with things like black box technology in cars, I mean, insurers were doing that well before the manufacturers got there in terms of telematics, for example. And to your point about systems, Paul, that's absolutely right. I think you know, we're seeing this drawn out process, and we're making progress steadily with pensions dashboards, for example. But you think about the legacy pension systems that exist and actually bringing all that data forward so that people can ultimately see multiple pensions. That is a challenge that's got to be overcome, but it's definitely happening.
Yeah, I'd add a few words on specifically the distribution point, and I'd say that it really depends where you look. So at the moment, around 80% of retail motor insurance companies use a price comparison website to find the cheapest policy. That's a very high share. Obviously, the market's very different from that of e-commerce where Amazon plays. But the point is that there are parts of the distribution chain that have been disrupted. Now, what we're beginning to see is the industry go full circle and say, is that a good thing? Is buying purely on price through a few very powerful platforms the best way for the consumer to get a good deal? And the answer is perhaps not. So I would say it depends where you look, but some parts are actually very advanced in that journey.
Yeah, can I come in there, Julie, just to say,
Yeah,
I mean, I think there's a sort of a philosophical debate in the background here around, you pose the question, is it, development of AI and involvement in insurance, is that the future? I mean, inevitably, yes. But actually, with that comes a whole bunch of considerations that companies have to give to their customers. We've only seen in the summer the fallout that you can have from getting the use of algorithms wrong. This big debate around an algorithm and A-level results. Frankly, that raises the bar from the political perspective in terms of the acceptability of some of this stuff, and it raises the bar from a customer experience as well. And Peter, you touch on sort of motor insurance pricing, and obviously we've seen that with, and you allude to this, the GI pricing review from the FCA. That is going to clearly disrupt what's become an established norm for many people using price comparison websites, which might more properly become known as product comparison websites, because I mean that's ultimately what we're talking about here, is that people shouldn't necessarily be shopping around on price, and many people do already.
Mm-hmm.
I like this discussion about the AI side of it and the customer's consideration, and what should they understand? What's your average customer's understanding of AI, and how do they understand that it's being utilized when their data is being processed? Paul, I have a question for you, kind of following up on that. So, if AI's ability to read and process masses of data could calculate risk down to the level of the individual customer or the individual person, what do you think will be the impact of this on the pooling principle of insurance itself?
Yeah, this is a great question. The sort of potential vitiation of the pooling principle of insurance by AI and data. I mean, this is something I looked at in my paper, my 2015 paper in Economic Affairs, which was the potential for insurance companies to use AI and to use masses of data, not just the relatively small amount of data they're using at the moment, but masses of data to build profiles of people almost down to an individual level and sort of tailor the pricing. Now, the problem with this is that it's very easy to breach rules of privacy, or what would be data protection or equality rules. And you have this, obviously, this controversy as well, that sometimes data can be regarded as a proxy for something else, and that you can and the difficulty, I think it's possible do it, and I think it's possible for insurance companies to do it. I think they're reluctant to do it because it's from a regulatory point of view and from a technology point of view, which we've already heard, because a lot of the back end of insurance companies isn't yet up to speed. But from a regulatory point of view, it's potentially very complicated, and especially in the sort of current political climate, because, as I say, data can be a proxy for other kinds of data. It does raise the prospect that sometime in the future, that insurance companies will, with more data, which presumably if it's given with the consent of the consumer, insurance companies will be able to tailor pricing and underwriting products to consumers in a way that can't be done at the moment. And you can imagine, for example, people who could insure themselves against all sorts of potential events that maybe aren't insurable now, or things happening in their life that maybe aren't easily insurable at the moment. And I think insurance companies will be able to do this. There'll be a whole marketing communications piece around it. But I think the idea of being able to go to an insurance company and say, what if I don't pass my exams and have to do this instead of that, or what if I have to move to that part of the world? Can you look at my profile and my data, and if I give you all the information, come back with a price in terms of what I think is a risk, essentially, because we have all sorts of risks and we live in a world of risks, and insurance insures relatively few of the risks we actually have to live with.
So do you think, follow-up question for you, Paul, do you think the customer is interested in this at all? Would they like to have a personalized profile, or is it something that they haven't even considered?
I'd say they haven't even considered it. And I'd say that if insurance companies start developing and trying to market much more sophisticated products, there is going to be a big communications piece, because much of our response to technology is driven by anxiety, and a lot of that anxiety is not always well informed. But in the case, I think there's also a counter direction in society, which I think we can see, which is that we live in a society where organizations can be seen to be wishing to instrumentalize the administration of products, and products that are so intimately affected or concerned with our lives, like insurance. This can become quite problematic. You can imagine, for example, if this passport, or whatever they're calling it, is implemented following people having had COVID tests. And I think if this is to come to fruition, where if you've had these COVID tests and you're clear, and therefore you have this document and therefore you can travel. Now, you can imagine insurance companies might conceivably be interested in that as a piece of data. And so there is a general concern by consumers that our lives are becoming slowly more administered with technology. This was envisaged by people like Theodore Adorno back in the 1960s, and Herbert Marcuse and people like this back in the 1960s. I think Marcuse wrote a book called One Dimensional Man about this. This is a real potential political worry, and it's not sort of people with tin hats hiding in basements. I mean, I think there is a legitimate concern about instrumentalization of data to manage people ostensibly for their own good. And I think this, if I can just, and I'll finish now, but I think this partly ties into what has been a very strong public policy direction in the last 20 years, probably since Tony Blair, of using things like behavioral insights, behavioral economics, to manage people and nudge them, as it were, and nudge economics. And I suspect that all of that's going to run into problems at some point politically.
Thank you. Any comments on this from the floor? Seth, I think you were.
Yeah, I mean, it's a big topic, right? You could talk about many angles of this. I mean, I think the one thing I would say is I don't think you'll ever get to a place where everything is either bespoke or everything is either automated. And there's a degree to which you get that bespoking already in parts of the customer journey. You know, sometimes it's via an element of the comparison website. Sometimes it's via the broker journey, and particularly if you're taking retirement decisions and you get some tailored advice, you know, that does exist to some degree or not already. I think, you know, back to this point about automation of some of these decisions, it's definitely the case that as these developments take hold, there's a huge job to communicate to customers so that they know what information is being fed in about them. And some of that is an active choice by, and you see this in the health space, some of the health insurance products going out now when you're wearing wearable technology in the hope that you will, you know, impact your premium, for example, or you can take steps to mitigate against flood risk, for example, and things that you're doing consciously. But if companies are using information, external data, to make judgments about customers, there needs to be a real degree of transparency about that. Yeah. Otherwise, you do store up problems later down the track.
Yeah.
What do you mean by transparent? Sorry, go on, Paul.
Sorry, no, I was just going to say, I mean, I mean, correct me if I'm wrong, Seth, but I mean, an insurance company could look, for example, at Facebook profiles and infer from that lifestyle. Obviously, it would know things like age and gender and that kind of stuff, but it could infer lifestyle, and it could even infer psychology, which it could potentially use to create risk profiles for individuals for all sorts of things. And I strongly suspect that assuming you add sort of medical knowledge to that, you could come up with some very accurate underwriting. The question is going to be, you know, at what point are you being penalized for something that you thought, you know, was private? So there is an issue there, I think, in the long term. Sure. And insurance companies are rightly wary of it, obviously, very wary of it.
Sure. And we've seen at least one high profile incident in the last couple of years of a company talking about openly doing that and getting the PR wrong on all of that.
Yes.
I mean, I would say actually that, you know, you cite Facebook. I mean, clearly that has been used in the past to catch fraudulent claimants as well. So, you know, there are ways in which this works both ways.
Yeah, absolutely.
Peter, you had a point?
Yeah, I was going to bring up the same point, which is that's actually happened for motor insurance pricing, and Facebook said no. But I suppose looking beyond that, the issue is if the power is in the data in order to build an accurate risk profile, then the question is who owns the data? As long as it's the customer, then the customer will likely be unwilling to share much of it. And we've seen a lot of that already in the motor telematics space. So it's still a pretty small product in terms of penetration, lower than 10%, because people don't want to share data on how they drive because it's invasive and they're worried they might pay more. What might change all of that is if the data is held not by the customer, but by, for example, the car maker. And the car maker has its own insurance company, and it uses data that automatically flows from the internet connected car to price insurance more cheaply than the driver could find elsewhere. And that data allows the driver to buy the car in the first place. Then that's a far more disruptive prospect than relying on people to voluntarily share it. And in fact, Tesla is thinking of doing something along those lines. So if it relies on the consumer sharing data, it won't get very far. If it's someone else who already has the data and there are benefits for all concerned, we'll see more of it.
I have another point on this. Seth, you mentioned the word, is that word transparency, and it's kind of following up on everything that somebody has said. But what do you mean by transparency? Is the customer supposed to understand how their data is being used, or are they expected to understand the decision that was made? You know, what's the line of transparency?
Yeah, I mean, I think it's both in a sense. I mean, customer understanding that, you know, it's not okay to sort of make a claim whilst actually your own sort of information that's out there in the public domain talks against that in some way. But it's also not okay to sort of make a judgment about a customer in a completely subjective way without relaying any of that information to the customer. So I think, you know, there has to be, without being really specific about what that framework would be, that, I mean, I think certainly from stepping back for a second from an insurance industry perspective, and in this year of all years, there are lots of learnings about customers understanding exactly what they're buying, exactly what they're getting. And I think alongside that goes exactly developing a better understanding of the risk that they present. And you can apply that to businesses, but customers also should be thinking about that as well. I was just going to make a point on Peter's comment about motor insurance, which is that I think, you know, in a sense, this is a market that's going to radically change over the next 10 years. The government set a target to move away from petrol and diesel by 2030, increase electric vehicles, got automatic lane changing coming in, we've got to move towards automated vehicles. So in a sense, you know, there's a kind of a momentum here where the sort of the decision to give over your data is going to be out of your hands in a sense, because actually the state to a large extent will be harvesting some of this data.
Yeah.
Chris, I'd like to hear if you have, from your point of view, what do you think of all of this?
I guess yeah, our proposition and kind of my background is very much focused on the broker market. So we're already dealing with professionals who are very well versed in insurance and risk transfer. But I mean, even so, there is with the platform that we developed, and there are kind of data entry points required by the broker on there. There is some hesitation there. There's kind of that that D&O kind of worry that they enter the wrong information, and so if that's a professional insurance practitioner, how is the client going to feel? I think it opens up quite a lot of questions really, and I think the insurance industry is going to have to get into a little bit more of a kind of product mindset, in the same way that some of the tech companies have built out their product, and really focusing on the customer journey and listening to that feedback.
Thank you. And thinking about that customer journey and thinking about the from their point of view, Peter, I have a question for you. So this digital innovation, digitally enabled threats grow daily, and the connectivity is growing exponentially. How has the industry responded to this facet?
So in two ways, really. Number one, in investing a lot in sustaining innovation, and the top 10 insurers spend getting on for $100 million on data and analytics each year, as an example, but also in reinforcing their position through, for example, more obvious and less sophisticated means such as brand, deployment of capital, navigating complex regulation. So to answer the question in brief, the industry is really responding in two ways: innovating, and a lot of that comes in the form of partnerships with insurtechs, for example, but also internal innovation programs. And then, to be brutally honest, number two is just reinforcing the barriers to entry that exist in the insurance market, which are pretty high. And the combination of those two, for now, in large part, is fending off disruption.
May I ask a question?
Yeah, go on.
It was always on my mind when I was working in the sort of insurance regulatory sector and looking at technology. It was a question as to why, people like Amazon or Google, well, maybe I'm behind the curve, why they weren't getting into insurance. And the answer to the question was always insurance required a specific expertise, and there were, not that it would matter to Amazon that much, but there were regulatory capital barriers to entry. Obviously, you've got to basically put a lot of money on the table to start an insurance company. But it's always been an interesting one for me. Why hasn't some big technology company bought some big insurance company? And my instinct about this, maybe Peter has an answer to this. My instinct about this is it has to do with the regulatory attention that it would require from the company, a potential risk of it not going very well, and the fact that it probably isn't going to be as profitable as whatever else they can do with their money. So I'd be interested in Peter's views.
I'd love Christopher's views on this, given that he works with Google and probably has an insight into why they've chosen that route into the market. I would say, broadly speaking, there are other easier, more profitable routes into the market than setting up an insurance carrier. So let's follow the path of least resistance. What I don't know about is China. You might find a different answer there. So some of the largest insurance companies in China should probably be better viewed as tech companies. I know people say, oh, we're a tech company and not an insurance company, but there it's probably true.
Yes. Okay.
I guess I'd add, I guess from my view, and obviously I don't speak for Google, but my view would be, I think the big tech companies are probably wary of the regulatory burden of an insurance company, and that getting regulatory reporting right and doing that properly, or getting it wrong, and the consequences of it are kind of the consequences, right? But I think they are doing some learning. I think the Google partnership with Key is a route them learning about the industry and spotting areas where they can bring products in to help kind of automate some of the chain.
What about the reputation point of view? Is that something important here? Would customers be comfortable with the big tech companies taking up space in the insurance domain?
I guess my view is, from a personal point of view, it wouldn't detract me from purchasing a policy with a large tech company. I think probably people in the industry would be a little bit wary of it. I think because there's that kind of threat of a very big, very high tech company coming in and kind of stealing a march on everyone. So I guess that would be my view. I don't know what the other panelists' thoughts are.
I was going to say, Julie, that I think, I suspect you're right, Chris. I think actually what matters ultimately to the customer is the experience when they have to make a claim. Because if you think about it, your contact with your insurance company and until that point is when you buy it. And if it's viewed through the prism of ease and price, then maybe the tech companies can trade on that basis. But actually, if you take it through the claims process and the treatment and the customer service, that's where the big established insurance companies are going to pride themselves on that experience. Now, we can have a debate about the quality of that, but actually compare that and that substantial element of it to what appears to be just a tech company wrapper, if you like. I think there's some real pause for thought there from the customer, the thoughtful customer.
Seth, I want to ask you about challenges in the insurance industry. So in a speech earlier this year, the Director General of the Association of British Insurers spoke of the tsunami of challenges. So right now we have the pandemic, more frequent flooding, faulty building materials, sophisticated cyber attacks, we haven't mentioned that really, global warming, just to name a few. Looking at all of these, how well do you judge the industry has responded to these challenges? All of them? No, just a few.
How long have you got? Yeah, I mean, what to say? I mean, this year of all years is exceptional, isn't it? And I think this isn't a static experience and it's ongoing. I suppose I'd start by saying that this is in a way at the heart of the purpose of insurance. It's there to respond to societal challenges, theoretically there to make it all better for the customer to guard against risk over time. And from that starting point comes the innovation. If you look at the Great Fire in London, fire engines right through to where we are now in the wake of Grenfell, still arguing for a change in the building safety regime to ensure that we get to a better place. I think on the whole, there's any number of, I mean, whether it's on the sort of general insurance side or on the long-term savings side, and there are any number of challenges where the industry is responding, but these are big challenges, and these are not challenges that are just there for the insurance industry to solve, but to play a part in working with government, with customers, and helping resolve. And yeah, for sure, this year with the pandemic, there have definitely been some low points and some challenges, and I've alluded to this before, but particularly the high-profile stuff around business insurance and business interruption insurance. There are some real learnings there in terms of what are these contracts designed to do, and how do we take that forward and ensure we guard against that? And indeed, if pandemics are a feature of the future, how do you work with government to ensure that you can develop something that's widely available? But I think if you look at the recent past, you look at climate change and flooding. And when I joined the industry in 2012, the state, both in terms of the response and the reputation of the industry, was pretty poor when it came to flooding. But now, 7 or 8 years later, with the development of Flood Re, the rollout of that body to support and ensure that there is access to flood insurance and affordable flood insurance for people who couldn't get it before, that's definitely testament to what the industry can do when it pulls together and works with government, works with other parts of the industry, and the wider sort of public sort of policy space, if you like. I can talk about any of these risks that are out there, and we can have that, we can have that debate. But I think on the whole, the industry is playing its role. It's never complacent. It needs to always continually seek to do better. And absolutely to the core of what we're talking about today, I think technology is going to be key to achieving that.
Excellent, thank you. Paul, I feel you have a...
I was just putting a scenario. I mean, I was just thinking of a scenario of if there's going to be a transformation, how's it going to happen? And I think, Peter and Seth have, expertly discounted the idea of some sudden disruption happening because Amazon come into the market and just buy or set up an insurance company, which, I mean, they could do, but I think the barriers reputationally for them and in terms of attention span are too high for potential rewards. But there was this talk about earlier on about how technology, how it's going to happen. And I think how it might happen is that, you have one insurance company saying to people, okay, we're going to use telematics, which is to say we're going to have technology in a car, and that's going to determine how you drive. Or maybe an insurance company is going to say, give us all your Facebook data, at least of the following kind of data, and all this other extra data, like not just 25 data points about you, but like everything about you, short of your DNA, which of course we know they can't use at the moment, but short of that. And if they then come up with, let's say for the sake of argument, very, very competitively priced insurance products, let's say life insurance products or health products, or motor insurance products, based on all that data that allows for much more accurate measurement of risk. What this means is that there are going to be people who have very good risk profiles that are going to be offered profitably cheaper insurance. And this does start to, I think, potentially destabilize the pooling principle. And that I think is a possibility. And so what you then end up with is you end up with insurance companies able to profitably sell insurance at say a lower rate or to certain individuals about whom they know much, much more. And this starts to drive up the price of insurance for people who either are more just higher risk in general, or who won't give them that data. And so this then potentially creates a kind of a momentum behind people saying, well, of course you don't have to give us all this data, but that means that we're going to offer you our plan B product, which is 25% more expensive, whereas our plan A product means give us all this data and it's a real bargain. And so the market itself starts to actually make these changes, and that's, I think, a very interesting question. Technology might take some time, but I think technology does have the capacity to generate its own momentum in terms of combining with new products that are just more compelling customer.
Okay, thank you, Paul. Peter or Chris, do one of you have a rebuttal or a thought on this?
Go on, Peter, after you.
Go ahead, please, Chris, go.
Yeah, I guess, I mean, a lot of the events that you listed, Julie, have hit the commercial sector insurance very hard. I guess, it feels like we're going from kind of catastrophe event to catastrophe event at the moment. And I just think it means that something has to give, right? I think, returns are low. Obviously, as Peter mentioned, insurtechs are entering the space. I think that, I believe that most insurers will be looking at themselves thinking, how can we lower some part of the balance sheet, right? Whether that's costs or the cost of claims. So I think it will kind of spur on innovation in the marketplace.
Okay, thank you. Peter?
Yeah, I think, again, it really depends. If I've understood the scenario correctly, it's some customers being willing to share a lot more data, and those people having access to cheaper insurance, because if you're willing to share data, you're likely a good risk. There's a lot of resistance to that. And therefore, I think for that to happen, we'd have to see something quite dramatically different. For example, as we mentioned, a car maker saying, okay, you can only buy this nice car, and we've got a really great brand that people love if you agree to share the data that's already being held by us on your driving. As I said earlier, I think if it relies on consumers voluntarily sharing their data, that's unlikely to work, except in small niches. For example, young, safe drivers who can pay £2,500, £3,000 per year versus, let's say, £500, which is a fairer price given their risk. But in small niches, yes, and we'll see a lot more of that. But in order for that to happen at scale, as I say, the ownership of data would need to change hands.
Yeah. I mean, it is there is a regulatory drift towards, I think, customers owning their own data, and the whole point of the GDPR, in a way, was to give effect to sort of de facto give people the kind of authority they would have if they legally own their own data as property, and therefore, essentially, I am lending my data to Facebook, or I am lending my data to an insurance company. And so if we simply say, well, Facebook won't allow this, well, at some point, I suspect maybe it'll be 10 years, maybe it'll be 20 years, some insurance company or some underwriter is going to come along and say, we figured out, we have this algorithm, really brilliant, and it figures out lots of life insurance type risks and health risks and so on and so forth, but we require 500 data points, including your Facebook history or wherever, whatever, and we can offer the product. So I think if the demand is there and the product is compelling, it's going to be very difficult for Facebook to sort of say no, given the regulators already decided, well, it isn't Facebook's data, decide that or not. So there is I mean, it's an interesting scenario, I think, and I suppose what I'm kind of positing is a sort of probably slightly Marxian in terms of sort of dialectical materialism. There's an inevitability that if technology is capable of this, it's going to happen. Sometime it's going to happen in the future, and it's just an interesting scenario. It may be science fiction at the moment, but I can see it happening at some point. It'll be an interesting challenge when it does.
Julie, I was just going
Seth,
to add to that it'll be interesting to see if that comes to pass. I think what we're seeing certainly in the wake of the pandemic is perhaps counterintuitively, perhaps logically, an increased interest when we sort of do focus group with the public around the need for a greater interest and awareness in the need to sort of protect against risks. That does mean that if people are serious about that, then they need to spend more time on it. And most people don't actually want to spend a huge amount of time thinking about insurance or buying insurance. So I think there is a tension here between what you're describing might happen, Paul, and I think a reality which is more in the sort of Peter camp of resistance towards actually spending any time on doing it.
Yeah.
We've got less than 10 minutes, so I'd like to look at the questions from the public, and I think we do it as like a quick fire. So I think the first one is for you, Seth, actually. How is the industry going to help the homeowners who are unable to obtain insurance owing to past flooding or living in apartments with cladding?
Okay, so I would say on flooding, that is already happening. I would say since I mentioned Floodry earlier, Floodry's been up and running since 2016. Since that, and that basically has meant that 97% of previous people who previously couldn't get affordable home insurance can now do that. And I think something like over 300,000 households have benefited from Floodry. So I think that is already having a transformational impact. We've got to get better at letting people know that's out there. I mean, Floodry is a reinsurance scheme that sits behind the insurance companies. So we've got to make the awareness better on that. I think on the cladding, we are strongly engaged with government, working to get them to improve the fundamentals of the building safety regime. And I think there are three issues here. It's getting the cladding off the building. And then there's the kind of regime for people who do inspections for new buildings, which rely on professional indemnity insurance. And then there's the kind of buildings insurance bit. But at the root of all of that, actually, is making sure the building safety regime, which Dame Judith Hackett, who did the inquiry, described basically as not fit for purpose, is in the right place. We're playing our part to try and get that in the right place.
Okay, thank you, Seth. The next one I'd like to throw over to Peter. It's from John Andrews. What is your view regarding the possible progressive disintermediation of insurance middlemen, middlewomen, as a result of AI blockchain evolution?
So on paper, it makes sense because intermediation adds cost, but a lot of insurance is really complex. So you need an intermediary, and a lot of people don't want to wade through that complexity. They want someone else to do it for them. So for large swathes of the market, intermediation plays a really important role. Obviously, there's a cost attached to that. So it really depends on where you look. I think what will be really interesting is to keep our eyes open for examples where disintermediation does happen. So, for example, in Christopher's market, is there scope to use, for example, auction-type platforms to automate the placement process, things like that? I think where all parties are aligned that there's a benefit, then we'll see it. But as it stands, because much of insurance is so complex, the need for intermediation is clear and will remain.
Thank you, Peter.
Is that okay?
Yeah, do please.
Yeah, I completely agree with Peter. I think that the broker's role is hugely important in that kind of complex risk transfer. I think where we might see some kind of straight through processing with using something like blockchain is something where it's more homogeneous risk, and then the broker's role will move to more, helping the market generate new products for new markets. I think that's what brokers enjoy doing. I don't think they enjoy the admin side. They enjoy the more innovative side. So I think we'll see their role kind of moving to more that direction.
Well, there's a related question for you then, Chris. Will the traditional model of selling policies via broker, will that survive?
Yeah, and I think it will. I think the administration side of a broker will slowly reduce down to something very small. And I think that there'll be the brokers will probably start focusing on markets that they haven't paid attention to. I mean, there's a huge amount under insurance in the world. You know, it's only really the kind of the Western countries that are insured, and so I think brokers will focus on that area. There's you know, insurance has still got a long way to go, I think, in terms of its access to certain areas and certain product types.
Okay, thank you. Paul, I'm going to throw the next one over to you. So digitally enabled threats grow daily and connectivity is growing exponentially. How do you think the industry has responded?
Digitally enabled threats.
Yes.
Well, I'm not a huge expert on this. Obviously, you have things like, I mean, insurers will have their own, you know, their own security in terms of their own platforms. But I think the question of insuring against being hacked or insuring against cyber attacks, it's not something I know a great deal about. I think you can buy insurance for these things. I could be wrong, but experts here would have to advise. I suspect that if you want to buy insurance against being attacked or hacked, then you're going to need to demonstrate what measures you have taken to prevent that in the first place. And that probably is quite a specialized field.
There's a related question then, and Seth, I'm going to throw this over to you. It's originally from David Smith from IORMA. Do you think the insurance industry in the future may focus more on the prevention Paul mentioned rather than compensation?
I think it's very focused on prevention now. I think, you know, there's definitely, you know, there's in the interest of the insurance industry to try and prevent the risk from translating into the reality. And I think that is at the heart of, you know, there are debates about whether or not you could do more in, you know, certain fields. And to the point about cyber, and one of the things that, you know, we lack from with cyber is information. If you look at property insurance, you've got hundreds of years of information about fire, for example. We don't have that with cyber. So you need to generate that data bank of information so we can sort of do the analysis and guard against it. So absolutely, I think, you know, they go hand in glove, the two together. And I think that's always been the case. Because, you know, unless you do much more of the latter, you do far more of the former, the compensation, and that's surely unsustainable over the long run.
Thank you, Seth. Does anybody want to comment on the company lemonade.com? Does anybody have a view of the likely impact of the AI-driven insurance model of lemonade.com? I'm not familiar.
I'm not familiar with this.
I mean, I think what that nudges at is the speed with which things are settled. And you know, it's sort of the sped up claims process. And the only thing I would reflect is that you do already see that happening. And I think, not to overstate it, but I think in clearly it's not uncommon actually for low value cash settlements to be settled very quickly. And that's only achievable really through technology, where you've got, you know, preponderance of people with cameras on their phones, and they can take pictures and they can send the pictures to the insurer, and stuff can be done very quickly. So I think, you know, what Lemonade represents is that speeding up of that process, and I think that is, you know, the rest of the industry is catching up, and that is happening.
Okay,
yeah, I'd add two things. So I don't really want to comment on Lemonade, the business itself, but I think there are two aspects of what they're doing that will be replicated elsewhere, and they are, number one, simplification of policy wordings. It doesn't sound a particularly exciting area, but if you look at Lemonade's policy wording, it's 16 pages, it's sparsely populated, it's in plain English. That sort of stuff will be replicated because, as we know from denied claims, people aren't always fully aware of what they're buying and what they're covered for and what they're not covered for. So simplification will happen, and Lemonade's been a front runner in that. The other aspect that we'll see more of, which Lemonade exemplifies, is a really good online customer experience. So the website is beautiful, and insurers are doing that, and we'll see a lot more of that because there's a lot more work to do, quite frankly.
Thank you, Peter. The last one more question. It's actually from a colleague of mine, Paolo Falcaran, and he's asking, what kind of measures do insurers require the software industry to prove they did the best? Am I asking that correctly? So what kind of measures do the insurance industry require from these tech companies, these smart startups, SMEs who are helping with the innovation? Paul, I'll jump to you first.
Well, I guess software providers, I mean, you know, this is a straightforward thing just about the software providers to the industry. And I guess, you know, it's probably the same with any other industry that, you know, stuff has to work and it's got to be supported. And so typically people who are selling insurance, I used to be the marketing head of marketing for a company that sells actually insurance technology called Finios, based in Dublin. And essentially the companies need to have scale. They usually, insurers are conservative. They'll be going to people like Deloitte and saying, you know, what should we put in our back end, or Accenture obviously are very big in this area as well. So it's going to be a question of does it work? Is it reliable? Is it secure? And if it's new, can we port our legacy systems or data over onto it and at what cost, and so on and so forth. So it's critical stuff, because if technology goes wrong in the insurance industry, especially in the back end, then you have no product. I mean, you know, insurance products are manufactured on technological systems.
Yeah. Okay, I'm gonna draw a line. We're going to leave it there, and I'd like to wrap up on what has been an extremely stimulating discussion. I've enjoyed it, and to offer a big thank you to all our panel members for their participation. So thank you to Paul, Chris, Seth, and Peter. It's been fascinating. Some housekeeping. Can audience members please remember to complete the post-webinar questionnaire? It will appear automatically, I'm told. The date of the next IORMA Insight is Wednesday, December the 2nd, I think. Actually, no, I don't have the date for that. Let me see, 2 weeks from today is the 10th. I hope I'm correct with that, but it's going to be on the IORMA website at 2 p.m. when Professor Philip Treleaven, Professor of Computer Science and member of the IORMA Advisory Board, will be talking about the global digital marketplaces he is developing for the insurance industry in particular. See more details on the IORMA website, please. And finally, there will be a recording of this afternoon's webinar available on the IORMA website again in the next 48 hours. And good luck, everybody. Thank you to all who participated. Thank you.